present Nicole Belson-Goluboff as today's conference speaker. Nicole is from Scarsdale, New York, and she is a lawyer who advocates for pro-telework legal reforms. She is the author of The Law of Telecommuting and The Law of Telecommuting Supplement. These are books described in the Employment Law Strategist as the seminal work on telework law. These books explored how the laws that typically apply in employment relationships may apply differently when employees work off-site. She's also the author of Telecommuting for Lawyers, which addressed telework as a law practice management strategy, and numerous articles on telework. She serves as the public policy liaison for the Association for Commuter Transportation's Telework and Alternative Work Arrangements Council, and as the legislative advisor to the Telework Coalition. Nicole?
Thanks very much, Sarah. Hi, everyone. So as Sarah indicated, I'm an attorney focused on the legal consequences of telecommuting. While there are many areas of law in which telecommuting has an impact, I'm going to focus today on certain tax aspects of telecommuting. I'm going to discuss two particular tax consequences of telework that can prevent both employees and employers who want to adopt telework from doing so. First, I'll explain how telecommuting across state lines can affect the personal income tax liability of employees. Specifically, I'll discuss the risk employees face of double state taxation if they live in one state and telecommute to an employer located in a different state. Second, I'll explain how telecommuting across state lines can affect the business income tax liability of employers. I'll discuss the risk businesses face that they will become subject to business income tax in a state where their only connection is a telecommuting employee. So let's start by examining how interstate telecommuting can affect the personal income tax liability of employees. We're going to take a look at a state tax rule known as the convenience of the employer rule. Essentially, in a state applying the convenience rule, if a non-resident works for an employer located inside that state and chooses to telecommute some or most of the time, he must pay taxes to the employer's state on 100% of his salary, not just on the wages he earns when he works in the employer's state, but also on the wages he earns when he works at home in a different state. Because telecommuters' home states can also tax the wages earned at home, telecommuters are threatened with double taxation on that income, taxation first by their home states and then a second time by their employer state. A number of states maintain a convenience rule. These states include New York, Delaware, Pennsylvania, and Nebraska. Now, because New York has been especially aggressive in applying its convenience rule, as I discuss the rule further, I'm going to focus specifically on New York's version of it. So what does New York's convenience rule say? It begins by setting forth a physical presence standard for determining how to allocate income that is earned partly within New York State and partly outside it. The precise language of the standard appears on the slide, but basically what New York says is, if a non-resident employee works partly within New York State and partly outside it, his New York source income consists only of the income he actually earns in New York. So, for example, if he spends 4/5 of his work time working in New York and the rest, say, working in New Jersey, 4/5 of his total compensation is New York source income and the rest is New Jersey source income. However, after setting forth what sounds like a physical presence standard, the rule provides a critical caveat. The non-resident can allocate the income he earns outside New York to the state where he actually earned it, but only if working outside New York is an employer necessity. If the non-resident works outside New York merely for convenience, he must pretend that the days he works outside New York are New York days and treat the income he earns on those days as New York source income. So suppose a Connecticut resident telecommutes to New York 2 days a week for convenience, maybe to avoid traffic or unreliable train service. He'll have to pretend that the days he works at home in Connecticut are New York days, and he'll have to pay taxes to New York on the income he earns on those days. Even if this Connecticut resident works nearly full-time in Connecticut and comes into New York for work only 1 day during the year, he may still have to pretend that the days he worked in Connecticut were New York days. So he may still have to pay taxes to New York on 100% of his salary, even though he earned almost every penny of it in Connecticut. Note that this telecommuter would probably not be obligated to pay New York taxes on his Connecticut wages if he never set foot in New York for work. But most telecommuters, even most full-time telecommuters, visit their employer's offices at least once or twice during the year. Now, why does complying with the convenience rule and paying taxes to New York on his Connecticut income present such a hardship for this Connecticut telecommuter? Well, there's that risk of double taxation. Why? Connecticut does not maintain a convenience of the employer rule. Unlike New York, it uses a true physical presence standard for determining where a telecommuter owes taxes. In Connecticut's view, the telecommuter should pay taxes to New York on the part of his salary that he actually earns in New York, but he should pay taxes to Connecticut on the part of his salary he earns in Connecticut. According to Connecticut, the compensation he earns at home is Connecticut source income. So he'll have to pay taxes to Connecticut on the wages he earns on his telework days. Because New York takes a different view, because New York considers the income the telecommuter earns in Connecticut as New York source income, he'll likely have to pay taxes again to New York on that same income. Now, there are situations where application of the convenience rule will not result in double taxation. Some states will give their telecommuting residents a credit for the taxes they pay to New York on the wages they earn at home. So these telecommuters will not wind up paying taxes to both New York and their home state on the same income. However, while these telecommuters will not be double taxed, they may still be excessively taxed. And that's because if the tax rate in New York is higher than the tax rate in their home state, they will still have to pay the higher New York rate on the home state wages. So they will still be penalized for making that choice to telecommute across state lines. So the penalty is pretty steep for non-residents of New York who telecommute for convenience. Remember, though, that under the convenience rule, a non-resident telecommuter might be able to allocate his home state wages to his home state and escape the telework penalty if he can prove that his working from home is an employer necessity. So let's take a look at the test New York uses to determine whether telecommuting is an employer necessity. That test actually changed somewhat in May 2006. Before 2006, New York took the position that telework was an employer necessity only if the nature of the work the telecommuter did at home was such that it could not possibly be done at his employer's New York office, like testing firearms or sports cars. Most telecommuters failed this test. The very reason that telecommuting is a viable work alternative in most cases is that it involves portable, information-based work that can be done anywhere. And if the work can be done anywhere, it can likely be done in a New York office. In May 2006, New York's Department of Taxation and Finance issued a memorandum purporting to set forth a revised position concerning the application of the convenience rule to telecommuters. You'll see the memo number appears on the slide in case you'd like to look it up, and you'll find that memo on the website of New York's Tax Department. The goal of the memo seemed to be to make it easier to prove employer necessity, but it failed. According to the memo, for tax years beginning on or after January 1st, 2006, in the case of a taxpayer whose assigned office or primary office is in New York State, any normal workday spent at the home office will be considered a day worked outside New York if the taxpayer's home office qualifies as a bona fide employer office. So a telecommuter essentially has to prove two things to be allowed to treat his telework days as home state days. First, he has to prove that the days he worked at home were normal work days. And second, he has to prove that his home office is a bona fide employer office. Each of these elements may be hard to prove. Let's look first at the requirement that the telecommuter's days at home were normal work days. According to New York, and I'm quoting the memo, a normal work day means any day that the taxpayer performed the usual duties of his or her job. For this purpose, New York says, responding to occasional phone calls or emails, reading professional journals, or being available if needed does not constitute performing the usual duties of his or her job. So, for example, if an associate at a law firm spent the day at home doing legal research for a client, maybe reading law review articles, and he replied to a few voicemail messages and emails, New York might not consider the day a normal workday. Rather, New York might say that he spent the day reading professional journals and responding to occasional phone calls or emails, and that as a result, his day at home was not a normal workday. The lawyer His firm and even his client might all consider that research day a normal workday for a lawyer, but under New York's narrow definition, it might not qualify. So satisfying the normal workday requirement could be tricky. Assuming that a telecommuter can prove that the days he spent working at home were in fact normal work days, he then has to prove that his home office is a bona fide employer office, and that test is even harder to meet. New York provides 3 sets of factors that taxpayers must use to determine if their home offices qualify as bona fide employer offices. The 3 sets of factors include a primary factor, a set of secondary factors, and a third set of factors called simply other factors. A taxpayer can prove that his home office is a bona fide employer office either by proving that he satisfies the primary factor or by proving that he satisfies at least 4 of the secondary factors and 3 of the other factors. What is the primary factor? A home office satisfies the primary factor if it contains or is near specialized facilities. What does this mean? According to New York, if the employee's duties require the use of special facilities that cannot be made available at the employer's place of business, but are available at or near the employee's home, the home office will satisfy the primary factor and will qualify as a bona fide employer office. This test is essentially the same test New York was using before 2006. Before 2006, a telecommuter could treat his home state days as home state days if the nature of the work he did at home was such that it could not be done at the employer's place of business. This condition was almost impossible to prove before 2006, and it remains so. Now, if a telecommuter cannot satisfy this primary factor, he can still try to prove the requisite number of secondary and other factors. But many of these other factors will also be impossible to prove. You'll see that I've included all of the secondary and other factors on the slides so that you can review them at your convenience, but due to time constraints, I'm going to mention only some of them. So what are some of the secondary factors that might help a telecommuter prove that his home office is a bona fide employer office? One is that the employer requires the employee to work from home as a condition of employment. Another is that the employer has a bona fide business purpose for setting up an office in the exact location where the employee happens to live. The employee meets or deals with clients, patients, or customers on a regular and continuous basis at his home office. And one more of the secondary factors, the employer pays the employee rent for the home office space and provides the employee with substantially all the supplies and equipment he uses. These conditions rarely apply. What are some of the other factors a telecommuter could try to prove? That the employer maintains a separate phone line and listing for the telecommuter's home office. The employee's home office address and phone number appear on the company's letterhead or business cards. The employee uses a specific area of his home separate from the living area exclusively for work. So, for example, the employee never uses his home office to pay a personal bill or to buy a gift online. The home office has a sign indicating that it is a place of business of the employer. Note that local zoning laws might actually prohibit commercial signs on residential properties, making this a particularly hard factor for some telecommuters to satisfy. And one more factor that I'll mention in this third set, the employer's advertising material shows the employee's home office as one of the employer's work sites. As with the secondary factors, many of the other factors will not apply in most telework arrangements. As a result, few home offices are going to qualify as bona fide employer offices. So, because the 2 key elements of New York's revised version of the employer necessity test can be hard to prove, because it can be hard to prove that days spent working at home are normal work days, and it can be especially hard to prove that a home office qualifies as a bona fide employer office, many telecommuters will not be able to satisfy this new employer necessity test. Okay, so we've explored how the convenience rule works. I'm now going to discuss some of the problems with the rule. Because the rule threatens workers with a double state tax bill, it is a powerful deterrent to telecommuting. This deterrent is very harmful to workers, people who have jobs and can't afford to telecommute because of the rule, and people who do not have jobs and who cannot afford to use telework to find employment in another state because of the rule. The rule also generates significant confusion for telecommuters. Some workers are startled to learn when they receive their first paycheck after telecommuting begins that they owe taxes to New York on 100% of their wages. People who have moved from New York to Florida, for example, or another state with no personal income tax, can be shocked to learn that they still owe state income tax on 100% of their salaries. Other people who are aware of the convenience rule may be unsure whether the rule covers them. For example, it can be hard to determine if you satisfy New York's multi-factor test for employer necessity. The convenience rule, though, is also very harmful to the businesses in the state applying the rule. One reason is that businesses that want to grow a strong telework program can't, because the rule forces workers to reject the telework option. Another reason the rule is harmful to businesses is that it can impose onerous payroll obligations on them. For example, just as workers find it confusing to figure out where they owe taxes, payroll departments can find it confusing to figure out where they have to withhold taxes for interstate telecommuters. Should they withhold in the telecommuter state, the company state, or both states? Some companies, particularly smaller firms, will throw up their hands and decide not to allow telecommuting because the administrative costs of figuring out the tax implications are just too high. Another problem is that companies may be slammed quite suddenly with withholding obligations that are really too great to meet. For example, New York's convenience rule applies only to employees, not independent contractors. To avoid the telecommuter tax problem, the company might decide to treat telecommuters as contractors and not withhold. If ultimately New York disagrees with the company's treatment of these workers and finds that they're really employees, the business may suddenly owe all the non-withheld taxes. So New York businesses that are interested in telework may suffer as a result of the convenience rule. There's a problem, though, also that the convenience rule creates for businesses that have no interest in telework. As I mentioned before, New York's convenience rule applies only to non-residents who spend at least some of their work time in New York. So the easiest way for a non-resident to avoid the rule is not to travel to New York for work at all, to telecommute on a truly full-time basis, or maybe to get a job somewhere else. When non-residents stay out of New York, they don't have lunch in New York restaurants, they don't buy memberships in New York gyms, they don't go to movie theaters in New York after work. These non-residents spend less money in New York, and as a result, New York businesses suffer. In short, the convenience of the employer rule makes New York businesses less profitable by preventing them from using telework effectively, saddling them with costly payroll burdens, and limiting the number of non-residents who patronize them. In addition to harming workers and businesses, the convenience rule harms states. It harms New York or any other state that applies the rule, and it harms the states where workers live. How does New York suffer? Well, when New York businesses are less profitable, New York State loses business income tax and sales tax revenue. In addition, when non-residents decide to stay out of New York because of the rule, even personal income tax revenue goes down. And that's because while New York does have the power to tax the income that non-resident telecommuters earn on the days they work in New York, once they stop working in New York altogether, New York loses any opportunity to tax their income. So states that apply the convenience rule actually suffer for doing so. What about the states where workers live? There are a number of reasons that they suffer. One is that states that give their telecommuting residents a credit for the taxes they pay to New York on the wages they earn at home can lose significant personal income tax revenue. They effectively forfeit to New York the taxes that their residents owe them. In doing so, they wind up subsidizing the public services in New York, like police and fire and emergency health services, even as their residents spend long stretches of time working from home and relying on the home state services. Another reason the convenience rule can harm workers' home states is that it prevents unemployed residents of those states from using telework to expand the area where they can look for a job. As a result, state residents may remain unemployed longer than necessary. This prolonged unemployment can further diminish the personal income tax revenue in workers' home states. In addition, because unemployed residents have limited purchasing power, the home state can lose sales tax revenue. And because reduced sales means reduced business income, the home state can lose business income tax revenue. So now I'm going to discuss federal legislation currently pending in Congress that would relieve interstate telecommuters and their employers of the convenience of the employer rule. The legislation is called the Multi-State Worker Tax Fairness Act. It was actually introduced last week on February 25th in the House. It's a bill that had been introduced in the 5 sessions of Congress before this one. In earlier sessions, it was known as the Telecommuter Tax Fairness Act. The current version of the bill is substantially the same as the earlier bills. The legislation would eliminate the convenience of the employer rule and the risk of double or excessive taxation for telecommuting. Specifically, it would prohibit a state from taxing the income that non-residents earn when they are physically present in a different state. And it makes clear that physical presence means physical presence. Neither New York nor any other state would be able to force non-resident telecommuters to pretend that they were working in the state just because they were working at home for convenience. Further, a state would not be able to treat those at-home days as not normal work time or non-working time or unpaid time unless the employer regarded the time that way. The goal of these provisions is to prevent New York from saying, you didn't do any real work at home. You really did all your work in New York, so all of your income is New York source income and subject to tax in New York. The bill has generated significant support. In the current session, Congressman Jim Himes, a Democrat from Connecticut, is sponsoring it. Representatives Rosa DeLauro and Elizabeth Esty, also Democrats from Connecticut, are co-sponsoring it. In prior sessions of Congress, lawmakers representing states across the country signed on to this measure, lawmakers from Maine to Washington state. They included both Republicans and Democrats. Voters from nearly all 50 states signed a petition supporting the bill, and the Federal Communications Commission, the FCC, urged Congress to act on it. In the National Broadband Plan, the FCC specifically recommended that Congress consider the legislation because of the negative impact the penalty has on Telework's growth. As you can see from the slide, there's also a diverse group of organizational stakeholders outside of government that has supported telecommuter tax relief. So now that we've explored how interstate telecommuting can affect the personal income tax liability of employees, let's turn our attention to how it can affect the business activity tax liability of employers. Specifically, we're going to look at the state taxation of non-resident companies that employ in-state telecommuters. Before I start this part of the discussion, let me define some terms that you'll hear me use. First, when I refer to a foreign corporation, I'll be referring to a corporation in a different state, not a different country. So, for example, a Maryland company may be a foreign corporation in the state of New Jersey. In addition, I'll be discussing circumstances under which a foreign corporation may have nexus for tax purposes in a state. Essentially, when I say that a company has nexus in the state, I mean that it has a sufficient connection with that state to justify the state's exercise of tax authority over it. A company might have nexus in a state for purposes of one kind of tax, but not another kind. For example, it might have nexus for sales tax purposes, but not for income tax purposes. I'll be focusing on whether employing a telecommuter in a state can cause a foreign company to have nexus in that state for purposes of corporate income-based taxes. Let's begin by taking a look at a case called the Telebright case. It is the leading case in this area. Telebright was a software development company, a Delaware corporation with its principal place of business in Maryland. In 2001, Telebright hired an employee named Srisacha Tirumalai to write software code. She was a Maryland resident, but after a few years she moved to New Jersey because her husband had to relocate there. Telebright agreed to retain her on a telecommuting basis. Telebright had no other employees in New Jersey, and it had no other connection to New Jersey. It had no office there, no financial accounts there, and it did not solicit sales there. Ms. Tirumalai received work assignments at home every day, either by phone or email. Her assignments consisted mostly of writing code. The code she wrote became part of the web application that Telebright supplied to its customers. She did not solicit customers. She had no responsibility for sales. She traveled to Maryland roughly twice a year to attend company-wide meetings, but apart from those trips, she worked entirely from home. When Ms. Tirumalai first began telecommuting, the company gave her a laptop computer to use for work. She later replaced that computer with a newer one, which she paid for herself. Telebright did not reimburse her for any household bills related to her work or for the costs she incurred when she traveled to Maryland. In sum, the only connection Telebright had to New Jersey was that this one employee telecommuted from there for her own personal reasons and essentially at her own expense. Telebright did withhold New Jersey gross income tax from Ms. Tirumalai's paycheck, but it never filed a New Jersey corporation business tax return. In 2008, New Jersey's Division of Taxation determined that Telebright was subject to New Jersey's Corporation Business Tax Act and, as a result, needed to file a return. In the division's view, the company was subject to the act because by employing a telecommuter in New Jersey, it was doing business there within the meaning of the act. Telebright challenged this determination before New Jersey's tax court. The company argued that it was not doing business in New Jersey within the meaning of the statute. In addition, it argued that application of the state's tax law to Telebright would violate both the Due Process Clause and the Commerce Clause of the U.S. Constitution. With respect to whether Telebright was doing business within the meaning of New Jersey's tax law, the court found that it was. The court relied on the fact that Telebright had an employee in the state and made daily contact with the state through this employee. Also, because Ms. Rumalai used a computer that Telebright supplied when she first began telecommuting, the company was, quote, employing property in the state. The court considered this further evidence that Telebright was doing business there. The court made two important points in its discussion of whether New Jersey's tax law applied to Telebright. First, the basis for taxing Telebright was not that Ms. Rumalai lived in New Jersey, it was that she worked there. As the court said, and I quote, "It is the location at which she receives her assignments, performs her responsibilities, and delivers her work product for Telebright that controls application of the tax law." According to the court, it was not relevant that she worked and lived in the same building. The second significant point the court made in its statutory analysis was that it didn't matter that Ms. Rumalai was Telebright's only employee in New Jersey. Telebright's contact with the state as a result of employing one telecommuter there was enough to justify requiring the company to file returns. So in the tax court's view, there was no statutory problem with compelling Telebright to file returns. What about the constitutional problems that Telebright raised? The court concluded that subjecting Telebright to New Jersey's tax law did not violate the Due Process Clause. The court explained that there's no due process violation where the company to which the tax law is applied has had fair warning that its activity may subject it to the state's laws. In Telebright's case, the court said the company's regular employment of Mr. Rumalai in the state gave it fair warning that it might be subject to the state's laws. The court also concluded that subjecting Telebright to New Jersey's tax law did not violate the Commerce Clause. The court explained that a tax on interstate economic activity does not violate the Commerce Clause if, among other conditions, the tax is applied to an activity that has a substantial nexus with the taxing state. And the court found that this condition was satisfied. The physical presence of an employee in a state on a daily basis for the purpose of performing business assignments is strong evidence of a substantial nexus for Commerce Clause purposes, the court said. According to the court, when Ms. Rumalai moved to New Jersey, she became, and I quote, part of the talent available to employers in New Jersey. By employing her, Telebright regularly took advantage of the benefits of New Jersey's labor market. In addition, the court said Telebright benefited from the protection of the state's laws. Ms. Rumalai had an employment contract with the company, and if she breached that contract while working in New Jersey, Telebright would have been free to use New Jersey's courts to seek relief. It benefited from a legal system in New Jersey that would protect the company's interests in the state. And Telebright chose to establish a workplace for Ms. Rumalai in New Jersey. These facts all supported the conclusion that the substantial nexus requirement was satisfied. In 2012, New Jersey's Appellate Division upheld the ruling that Telebright was subject to tax in New Jersey. It determined that Telebright had a sufficient connection with the state to satisfy the Constitution because Ms. Rumalai produced computer code for Telebright in New Jersey. She was entitled to all of the legal protections New Jersey provides to its residents, and if she violated her employment contract, Telebright would also be entitled to legal protections in the state. In its discussion of the Commerce Clause, the appellate court explained that the fact that Telebright's employee worked from home rather than an office owned by Telebright is irrelevant for purposes of determining whether the tax satisfies the substantial nexus requirement. One argument that Telebright made to the appellate court under the Commerce Clause was that given the prevalence of telecommuting, taxing businesses on the grounds that their employees telecommute would impose an undue accounting burden on those businesses. But the court disagreed. The company was already withholding state income tax from Ms. Rumalai's salary. It was already subject to New Jersey's labor laws and anti-discrimination laws concerning this employee, and it was required to remain apprised of those laws. According to the court, Telebright failed to explain why the added effort of paying the corporation business tax would constitute an undue burden on the company's conduct of interstate commerce. Now that I've explored the tax court and the appellate court decisions concerning the state law and constitutional provisions that actually governed the Telebright case, I want to go back for a moment to the tax court decision to consider an important footnote the court dropped about non-governing law. At the end of the tax court's opinion, it indicated in this footnote that Telebright would not be able to avoid tax exposure by relying on Public Law 86272. 86272 is a federal statute which, in addition to the U.S. Constitution, limits states' authority to impose income taxes on out-of-state companies. 86272 prohibits states from imposing a net income tax on income that a foreign company derives within the state as a result of interstate commerce when three conditions apply. First, the only business activity the company conducts within the state is soliciting orders for sales of tangible personal property, things like furniture or jewelry. Second, the orders are all sent outside the state for approval. And third, if the orders are approved, they're filled by shipment or delivery from a place outside the state. When these three conditions apply, the state may not impose a net income tax on the out-of-state company. Since Mr. Rumelai's job did not involve soliciting orders from customers on behalf of Telebright, the tax concluded that 86272 did not apply in the case. Just like New Jersey's tax law and the U.S. Constitution, this federal statute afforded Telebright no protection from tax. I mention this footnote about 86272 because 86272 is about to become important as we consider how other states might handle a case like Telebright. So, how prevalent are state nexus policies like the one articulated in Telebright? The evidence suggests that they're very prevalent. In April of 2013, Bloomberg BNA released its 13th annual survey of state tax departments. The next one should be coming out this spring. One goal of this survey is to clarify the positions that state tax departments take on what activities within the state will create income tax nexus for foreign companies. As in earlier years, the 2013 survey asked about telecommuting. Specifically, it asked whether a foreign company would have income tax nexus in the state if 6 or fewer employees telecommuted from their homes in the state, and all of those employees performed non-solicitation activities, that is, activities that are not protected from tax by 86272. When answering this question, respondents were asked to assume that the foreign company had no other activity in the state apart from the presence of these telecommuters performing non-solicitation activities and apart from activities that are protected from tax by 86272. 44 jurisdictions responded to this question, including 42 states, the District of Columbia, and New York City. Of the responding jurisdictions, 38 said yes, having 6 or fewer employees who telecommute from their homes in the jurisdiction and who all perform non-solicitation activities would create income tax nexus for a foreign company. As in past years, the states were also asked to indicate whether they would have reached a different conclusion if the company made no sales in the state or if the employees telecommuted for only part of their total work time. Only some jurisdictions addressed these additional questions. Roughly 18 states said expressly that Telework would create nexus in the state even if the company made no sales there or the employee was only a part-time telecommuter. In 2013, BNA also asked whether a company would have nexus if there were one telecommuter in the state and he performed back-office administrative functions like payroll rather than direct customer service or other activities directly related to the employer's business. And BNA also asked whether a company would have nexus if the telecommuter performed product development functions like computer coding. 40 jurisdictions responded to these additional questions. Of the 40, 33 said yes, a company would have nexus if a single telecommuter was there who performed back-office administrative functions like payroll rather than activities directly related to the employer's business. And 34 said a company would have nexus if the telecommuter performed product development functions like computer coding. A number of states indicated that the answer to one or more of these questions about telework would depend on the particular facts and circumstances of the case. And BNA suggests that the particulars of the case always matter. According to BNA, and I'm quoting here, because nexus determinations are fact-specific and subject to interpretation, the state's answers should not be relied upon as definitive policy statements. So, while a majority of these states appear to take the view that the presence of one telecommuter engaged in non-solicitation activities is enough to trigger income tax nexus for a foreign company, any company considering employing a telecommuter in another state should try to determine how the telecommuter's home state will view not telework in general, but the particular telework arrangement that the company is considering. Towards that end, the company should do two things. First, it should make sure it knows the current law in the telecommuter state on the Nexus issue. That is, the company should learn whether there have been any judicial opinions, new statutes, or new regulations that address the Nexus question. Second, the company should make as thorough an assessment as possible of how the tax department will treat the specific situation the company is considering. For example, the company should determine whether the tax department has issued any administrative guidance, any opinion letters perhaps, on the subject. Now that we've taken a look at how common the view is among states that engaging just a few telecommuters in the state creates income tax nexus, I'm going to consider the practical impact this view can have on the growth of telework, on workers, on businesses, and on states. First, how do state policies that treat a limited amount of telecommuting as a basis for income tax nexus affect the growth of telework? Well, they can actually have two somewhat contradictory effects. Namely, they can promote telework and they can deter it. How can they promote telework? When a state asserts that a telecommuter's work in the state constitutes sufficient business activity on the part of the employer to justify taxation, the state validates telework as a business practice that benefits employers as well as employees. For example, in Telebright, the New Jersey tax court emphasized that employing the telecommuter was a business decision intended to benefit Telebright. According to the court, and I'm largely quoting again here, Telebright regularly enjoyed the benefits of New Jersey's labor market by employing a telecommuter there. Telebright decided, presumably for business reasons, that Ms. Rumulai is valuable enough as an employee to warrant granting her permission to work from home despite her relocation to New Jersey. The court made clear that the employee's days at home were real work days, not vacation days. As it explained in its analysis of the New Jersey tax statute, and again I'm quoting, it is the location at which she receives her assignments, performs her responsibilities, and delivers her work product for Telebright that controls application of New Jersey's tax law. From a substantive perspective, it is not relevant that she works in the same building in which she resides. Similarly, the appellate court in the case made the point that the fact that the employee worked from home rather than an office owned by Telebright was irrelevant to whether the tax satisfied the substantial nexus requirement of the Commerce Clause. What was relevant was that she was producing a part of the company's product, what they sell, in the state. The view of the New Jersey courts that the work Ms. Rumulai did at home served her employer's needs helps diminish that long-standing misperception of telework as merely a dispensable employee perk or accommodation, and that somehow telecommuters really spend the day watching TV rather than working. Now, while treating telework as a nexus-creating activity can advance telework, it can also thwart telework's growth by discouraging employers from allowing it. A company might want to use telework to retain a valued employee who has to relocate. It might want to hire a new employee to telecommute from a distant state, but it may very well decide not to proceed because it does not want to risk tax liability in the worker's home state. As a practical matter, the potential of such nexus policies to deter telework is probably much greater than their potential to promote it. So now let's consider the impact that these deterrent policies have on workers. Well, they shrink the number of telework opportunities that are available to workers. They hurt employed people who want to telecommute but whose employers won't let them because of the corporate tax risk, and they hurt unemployed people who cannot use telecommuting to look in other states for work because employers in those other states won't take the tax risk of hiring them to telecommute. These nexus policies also harm companies by forcing them to limit telework and to forfeit the many business benefits of a scattered workforce. In addition to harming out-of-state companies, such nexus policies can harm businesses within the states that apply the policies. New Jersey, for example, can harm its own businesses by treating limited telework as a nexus-creating activity. As I suggested during my discussion of the convenience of the employer rule, when foreign companies are discouraged from offering telework to New Jersey residents, unemployed people in New Jersey may remain unemployed for a needlessly long time. They may not be able to use telecommuting to widen the area where they look for a job. And when residents are unemployed for an extended period, they lose buying power. So they spend less money in the stores and other businesses in their own state. As a result, these in-state businesses can suffer. And as I also mentioned earlier, when a state's businesses suffer, the state itself suffers. When sales go down, the state loses sales tax and business income tax revenue. In addition, the state can lose personal income tax revenue. Again, when workers cannot use telework to look for jobs outside their own state, they may remain unemployed for significant periods, and they may generate less personal income tax revenue for their states. So the states that are trying to increase their revenue by taxing foreign companies with in-state telecommuters actually stand to lose revenue. In sum, while treating a limited amount of telework as a nexus-creating activity for foreign companies can help validate telework as a business practice that benefits both employers and workers, it can also discourage companies from offering telework opportunities to workers in other states. And the deterrent effect of such a nexus policy is harmful to workers, the foreign companies that might want to employ them, companies within the states that apply the nexus policy, and the states that are asserting nexus themselves. So that concludes my prepared remarks. I thank you so much for listening, and I welcome any questions you might have.
All right. Nicole, thank you so much for that presentation. It was an information-packed presentation on tax penalties, and I encourage all of you who have been listening to this net conference to offer your questions by typing them into clicking on the Q&A up at the top of your screen and putting in your questions so that we can pose them to Nicole. So while we're waiting for questions that the audience might have, I've got just a couple questions. Going back to the first issue with personal tax liability of employees, could you give us a sense of how many people you estimate might be affected by this?
Sure. Well, there are a number of ways to look at the population who is affected by the convenience of the employer rule. One way to look at it is how many people are actually being double taxed or taxed excessively under the rule today. And numbers for that are very hard to get a handle on. There are also these workers who are discouraged from telecommuting because they know there's a double tax penalty in store for them if they start doing that. And that's also, I think that's truly an unknowable number. There are people who make the decision not to telecommute because they don't want to incur the tax risk of doing so. There are also a vast number of people, actually over 1 million people, who currently live in one state and work for an employer that is located in a state that maintains the rule. And they may become subject to the rule as soon as they start telecommuting. And telecommuting here doesn't necessarily mean a structured work arrangement pursuant to a written contract. It means as soon as they have a snow day and they have to work from home, they may, and maybe there are 3 or 4 such days during the year, they may become subject to this rule. They may find that they have a tax bill that year or the next from their own state as well as their employer's state with respect to the income that they earned when they teleworked. So those are people who may not regard themselves as telecommuters but may become sort of unwitting telecommuters. And again, there are over 1 million such people in the United States today who are living outside a convenience rule state and working for an employer to whom they might occasionally telecommute in the convenience rule state. And then there's the concern that while right now there are only a handful of states that maintain the convenience rule, again, New York, Nebraska, Pennsylvania, and Delaware, more states may be incentivized to adopt the rule. It is an extremely attractive prospect for cash-starved states to tax non-voting non-residents. New York has been applying this convenience rule very aggressively for decades. There were 2 cases which actually made their way to the U.S. Supreme Court where non-residents of New York were double taxed or excessively taxed under the convenience rule and challenged the constitutionality of the rule as applied to them. The New York courts all said the rule is fine, it's entirely constitutional, and when appeals were brought to the U.S. Supreme Court, the Supreme Court in both cases declined to hear the appeal. The consequence of that was that any state in the nation is free to adopt the convenience rule. So a long answer to your question about numbers. There are, just for example, tens of thousands of people who commute between Connecticut and New York who are subject to this rule, many of them double taxed because they are aware of the problem. There are hundreds of thousands of people who commute from New Jersey to New York. And again, there are over 1 million Americans who work outside a convenience rule state for an employer in a convenience rule state. So these are all people who are potentially subject to the rule.
Okay, thanks, Nicole. I've got a couple questions that have come in. The first one is, do you know what other states tax interstate telecommuters? And the person who's posing the question says that he believes Georgia does. For example, what effects can this have on employees who live in states without state income tax?
Okay, so sounds like there are two parts to that question. In terms of other states, the states that I'm aware of that have some version of the convenience rule on their books are the ones identified in the presentation, Pennsylvania, Delaware, Nebraska, and New York. I am also aware of non-residents of Georgia who telecommute to an employer in Georgia who are being taxed on their out-of-state income. And I believe that a number of things are at play here. There are these states that have on their books some version of the convenience rule, and then there are states whose tax departments may, as a practical matter, be taxing non-residents who they deem to have Georgia source income because the employer is located in Georgia. So I think there are states that technically maintain the rule, and then there are states where, as a practical matter, you may be subject, a non-resident may be subject to tax on their out-of-state income for telecommuting to that state. So I think there are sort of, there are places where the rules may not be so clear, but non-resident telecommuters are very clear on what's happening when they look at their paycheck. As to the second piece of that, which is what happens when you live in a state, say like Florida, where there's no personal income tax. So one of the cases that I mentioned, the litigations that went to the Supreme Court challenging the constitutionality of the rule, one involved a telecommuter from Connecticut who was double taxed, but the other involved a telecommuter from Tennessee where there was no income tax. And what happens in those cases is clearly there's no double taxation, but if you're a person who makes a conscious choice to live in a state where there's no personal income tax, you may make financial decisions, including whether to buy a home or which home to buy, and perhaps some retirement plans. You may make financial decisions based on the assumption that you do not owe income tax on your salary. But if you work from Florida, from your Florida home, say, for your New York employer, and you travel to New York even one day during the year, you will discover that you are subject to tax on 100% of your salary. So you're not double taxed, but you went into the no tax state assuming that you were not going to be taxed on your salary, and basically you carried with you from New York the tax burden of income tax on all of your salary, not just the 2 or 3 days or even 15 days that you spent in New York, but every penny that you earn. So the tax penalty that you're suffering, again, is not double taxation. It's the fact that you're being taxed when you deliberately chose to live in a no-tax state. In addition, some of the states where there is no income tax may impose a sales tax or other taxes that are uncommonly high to compensate or to make up for the fact that there's no income tax in the state. So in effect, the telecommuter is double taxed anyway because he's paying much higher sales tax, for example, and now income tax to boot, which again, he sort of thought he wasn't going to have to do.
Okay, great. We have a second question, and I'm just going to read the question here. It says, are there any examples that you know of that address how a local or city wage tax may be affected by telework? And then she says, in Philadelphia, we do not have to pay city wage tax for days we are not in the city, whether at meetings or out sick or on vacation. I'm guessing the same would hold true for telework?
I'm afraid I can't speak specifically to city tax laws. There may be, I know, for example, so New York State has this convenience of the employer rule, and it is possible that if you, I haven't read too carefully about Yonkers, which is a region within New York State. They may also apply the rule. I would imagine that you really need to look, if your employer is located in Philadelphia, you've got to look at that city's tax rules. Now, I do know that Pennsylvania, again, is one of the states that has a convenience of the employer rule. So if you're talking about commuting between cities within Philadelphia, that may involve one set of rules. If you're talking about commuting from a city outside Pennsylvania to Philadelphia, that may involve something different. So I can't really speak to city taxes. This tends to be a state tax issue, and the reason we're so eager for Congress to be involved is that, again, it concerns interstate commerce. It essentially involves one state reaching into another state to tax the wages of non-resident of the residents of that other state who are working there.
Okay. Our next question is, how does a state learn that someone is telecommuting occasionally?
That's a great question. So the way it works in Connecticut and in the Connecticut-New York region is that Connecticut will give you a credit. If you live in Connecticut and work in New York, Connecticut will give you a credit for the taxes you pay to New York for the wages you earn on your New York days when you actually travel to New York. And it asks you to say, and it will not give a credit for taxes paid on wages earned within Connecticut. So you have to tell Connecticut the days that you spent at home and the days, or that is to say in Connecticut, and the days that you spent in New York. Similarly, New York's form says, tell us how many days you worked outside New York. Now tell us how many of those days were days you worked at home. Now subtract the days you worked at home from the days you worked outside New York, so that your days worked outside New York are deemed to be only those days somehow that you weren't working at home. The penalty is very clearly for working at home. So if you fill your tax forms out properly, you should be telling both states where you were. So as a practical matter, there may be people who do not report days at home, frankly, because they may not even remember them. But if you live in Connecticut, I don't know if anyone on the phone is from Connecticut, but if you live in Connecticut, you know that Metro North halted service 3 times this year for various disasters that they had to manage. Those people are not going to forget that they had to work at home because the complete absence of the most widely used rail line in the nation was really called itself to folks' attention. So you should be reporting honestly where you worked. As a practical matter, one way that this comes up is on audit. So I've learned of a case recently of a Pennsylvania telecommuter with a New York employer who for years had this telecommuting arrangement, and New York seemed okay with it and actually issued him a refund for taxes paid to New York, and all of a sudden said, not only are we no longer going to give you a refund, we want a refund. We want back taxes for all the years you've been doing this within 3 weeks. The sum that he owed was over $100,000 in 3 weeks. So I think it comes up on audit, and it comes up if you are filling out your tax forms properly and acknowledging where you were, how many days you really worked in the convenience rule state and how many days you really worked in your home state.
Okay. All right. Our next question. Does this issue with New York affect people who might not be considered teleworkers? For example, you work in Massachusetts, pay Massachusetts state tax, but travel to New York to visit your company's New York office for a business meeting?
Okay, so New York, the convenience rule applies to people who New York says have their primary office in New York. So I can give you another illustration. I'm aware of a lawyer who lives in Oregon and telecommutes to her law office, which is located in California, but it is a national office with branches around the country, and a fair amount of her work is work that she does with partners in the New York office. She is assigned to the California office. She originally was an on-site lawyer in the California office until she worked out this telecommuting arrangement. So her primary office is deemed the California office, and at least under New York's guidance, which is extremely vague, and I can't really give you a definitive answer to your question, but at least under their guidance, there's a fair argument that these visits from Massachusetts to New York, when New York is not your primary office, would not bring you under the umbrella of the convenience of the employer rule. That said, New York is more than a little bit vague on, it's not clear where the primary office is. So if you were audited, if a telecommuter were audited, New York might make the case, potentially, that if you're coming to New York enough to work with members of your own firm there, with colleagues at your own firm, maybe your primary office is subject to interpretation, and maybe you're really based in New York and you owe taxes on all your out-of-state income.
Okay. All right. We still have a few minutes left for more questions. If you have any more questions, let me know. I was just curious, Nicole, what about the trucking industry? How does it, we've been talking mostly about workers that, work in offices. And I was just curious how this whole issue of tax penalties might affect other sectors as well, such as the trucking industry.
Well, again, this convenience of the employer rule is specifically geared to individual employees of a New York-based company who spend part of their time working inside New York and part outside it. There are some very significant issues about trucks being stopped in states where their company has no real physical presence. They're just literally driving through. And the state where they're driving through is very aggressive about stopping them. I would encourage you to read an article in City Journal, which you can find online, by someone named Steve Malanga. I believe the article is called State Tax Grab, and it does address these instances of truckers being stopped in states where their companies are not located, and the companies being saddled with enormous tax liability just because these trucks were driving through. So I'm not sure if that answered your...
Yes, it does. Yes, it does.
It's a different issue because, again, this is personal income tax liability that the convenience rule addresses, but there are significant issues with other kinds of multi-state travel. And what this article addresses is the increasing interest on the part of states to tax non-residents who really don't have a meaningful presence in their state.
Okay. One other question. Do you know if there is any exception to these tax rules for someone with a disability that limits their mobility?
There is, if you're referring specifically to the convenience rule, there is not, and that's a huge concern. So if I am telecommuting to my employer most days of the year because I have a disability, and in fact, I am entitled to this telecommuting arrangement under the Federal Americans with Disabilities Act, and perhaps even under my state's version of the ADA, New York may nonetheless say that because my telework arrangement is not an employer necessity, because I didn't satisfy that multi-factor test, I'm subject to tax on 100% of my wages. So really, there is a penalty imposed on the employee for structuring an arrangement with her employer or his employer which is compliant with federal law. There are many ways in which this convenience rule contravenes federal law and federal policy.
Okay, great. Just one more thing. Nicole, you've been very active in the very short time that you've been working with the Telework and Alternative Work Arrangements Council in exploring these issues and problem solving with regard to, what can be done. And could you just say a word about some of the things that you've been doing with the Telework Council to help professionals in this business learn more about it and get involved with it?
Well, there are this federal legislation, the Multi-State Worker Tax Fairness Act, is really what I consider a crucial reform. Again, it would eliminate the penalty for telecommuting across state lines, and the Association for Commuter Transportation and our Telework Council have composed letters that people can send to their delegates in the House and in the Senate to urge them to support this bill. We have a letter of support that organizations can sign on to, and the best way to find out sort of how you can urge Congress to make this bill law would be to, at this particular moment, would be to contact me. My contact information is in the slide presentation. I can get your organization's name on the letter of support, and I can send you letters of support that you can send to your individual reps in Congress.
Okay, great. I see we have actually one more question that came in, and I think we have a minute or two to field this question. Does international status take precedence over state status? For example, a European-based company with an office in Boston, but an employee who teleworks full-time from Pennsylvania. Is this still a Massachusetts, Pennsylvania tax issue?
I'm sorry, can you repeat the international piece of that?
Sure. The question is, does international status take precedence over state status? For example, a European-based company with an office in Boston, but an employee who teleworks full-time from Pennsylvania. So would this still be a Massachusetts/Pennsylvania tax issue?
Well, here's the thing. With the issue here seems to be whether this company's international, perhaps headquarters, is the place to which the Pennsylvania telecommuter telecommutes, or the Massachusetts office. In this case, we're lucky because Massachusetts, I don't believe, has a convenience rule. I think it does not have a convenience rule. So it wouldn't, in that particular scenario, be an issue. Again, I think let's say it were a New York company that had international headquarters. Again, I think the issue is not so much where your paycheck comes from, it's what New York considers your primary office. And again, New York is not so clear on that point, so there might be some guesswork to be done there. But if you are, if New York perceives that you are, or another convenience rule state perceives that you are telecommuting to that office and that is your primary office, that's when the rule is going to kick in. Now, there may be tax implications if you are actively involved with the international office, but I can't speak to those issues. I can, however, for anyone who might need to learn more about international telecommuting, I can steer you to someone, if you reach out to me after the presentation, who might be able to help you there.
All right. Nicole, thank you so much for giving this presentation. This has been very interesting. It's a topic that I think probably most of us are not very familiar with, and we very much benefit from your expertise in bringing this to our attention and helping us understand a little bit more the implications of this to telework. And Nicole, you did say that you will be available to take any other questions that the conference attendees might have once the net conference is over, and you might think of something. Nicole, you said you would be available to answer those questions. Thank you so much. Yes. All right. So this wraps up our net conference on tax penalties for telecommuting. I'd like to thank you for your attendance. This net conference was co-sponsored by the Nectar Best Workplaces for Commuters and the Association for Commuter Transportation's Telework and Alternative Work Arrangements Council. Thanks so much.